Credit card changes are coming. I'm your host, Steve Van Metre, and thanks for joining me today. You want to act now before your bank makes these changes to your credit card. Let's over to Bloomberg, where we picked today's story up with a headline: the banks bet on subprime consumers since credit card balances to a record, as cards issued to customers with credit blemishes are surging. Now, something I want you to understand that this is very normal in a late cycle economy. What banks will do is they will seek out their best customers first, the ones they really want to loan to. But when that well dries up, they'll turn to the people they really would rather not lend to because they're desperate for business. So when you hear that they're going after people with low credit scores, that's very normal at this point in the game. Balances soared to 19% or $866 billion, with an average credit lines also climbing to an all-time high. And this jump came after card originations, here is keyword, subprime consumers, climbed to more than 12% in the previous 3-month period as banks load up on risky debt. In this inflationary environment, consumers are increasingly turning to credit. Now, this is a case that we've made on the show repeatedly, that when a consumer, their wages are not keeping up with inflation, they will turn to credit cards to keep up their lifestyle. They will do this only as long as the credit card companies will extend their balances. When they can no longer get credit, that whole game starts to change, and that's where you see the economy start to turn down. TransUnion went on to say that this is particularly true among the subprime segment of consumers, the people who are hit the hardest by inflation. And in this chart here from the St. Louis Fed database, we look at total consumer credit card loans in blue and other revolving plans against the consumer price index. And what we want to see here is consumer prices rise in red. What we see is usage of credit cards and revolving loans goes up, and it makes sense. During recessions, when banks cut off the ability to borrow, well, people end up paying them down. And you'll note here a period where inflation is trending lower, you see the credit card and revolving loan balances start to flatten out. But as soon as inflation starts to head higher, demand for credit goes up. You'll notice during the pandemic, what did we see? Due to government transfers of fiscal stimulus, credit card balances went down along with inflation. And then as inflation took off with a lag, you'll notice consumers are back to you tapping their debt. And this is going to continue, but not for a whole lot longer, because the banks have some big changes coming, and it's going to catch a lot of borrowers off guard. As credit card interest rates now hit record highs, which coincides with the Federal Reserve raising its key federal funds rate to a level not seen in more than a decade, as it fights what it sees as persistent inflation. The cost of carrying a balance on your credit card is now the highest it's been in more than 30 years. So again, I want you to think about what's going on with the average consumer here. They have a record amount of debt. Their wages are not keeping up with inflation. And the Federal Reserve says, hey, we're going to keep jacking up interest rates to the point now where you're paying the biggest interest cost in 30 years on the largest amount of debt. So when we talk about the Federal Reserve's ability to impact the economy, all they're trying to do is change aggregate demand. By lowering rates, they try to pull demand forward by getting you to go borrow and buy something now that you might have waited to do in the future. By driving rates higher, they get you to focus on paying down your debt and push that demand back when you can actually get the credit or can afford to make the payments. According to a survey from Bankrate.com, the average credit card interest rate has now climbed to 19%. And guess what? That number is only going higher. The new high coincides with the Federal Reserve raising its key federal funds rate to a level not seen in more than a decade as it fights persistent inflation. The central bank hopes making it more expensive to borrow, key part of this, will slow the economy and ease upward pressure on prices. Again, they're betting that this works. Now, if wages continue to go higher and inflation comes down, that won't work for the Fed, but that's the plan, again, is to push aggregate demand back and drive inflation down and hope along the way they don't crash the economy. And we can see the Federal Reserve's effect on credit card rates. Now, unfortunately, this is the best way I could present this data from the St. Louis Fed database, but we'll note in blue commercial bank interest rate on credit cards, against red the federal funds rate. So you note when the funds rate is high or pushing higher, that credit card interest rates stay high. As the Fed lowers rates, we see that interest rates on credit cards fall. And then again, as Fed raises rates, those credit card rates go back up. Here we can see it again back at 2016 going into 2019. Credit card interest rates went higher, and now they're shooting up as the Fed makes aggressive moves on the federal funds rate. But it's only going to get worse. Because here we can note that with a lag, credit cards don't see the effects of the federal funds rate moves for about 2 months. And since that article, we've seen 1.5% increase in the federal funds rate, meaning borrowers can expect coming into January and February that they're going to see an even bigger interest cost on their already record high balances, making it even harder for consumers to deal with record inflation. But it's not just credit cards that are taking an impact, it's also personal loans. As personal loan interest rates are also a near record gap with credit cards, boosting savings opportunity as personal loans can help pay off credit card debt at a lower interest rate, potentially reducing your monthly payment. As the average interest rate on credit cards was 16.27% in August, now think we're going to add on 1.5% on that, pushing that number near 18%, while the average interest rate on a personal loan, if you can get one, was 10%, but think that number is also likely to get closer to 12%. This marks one of the largest gaps between commercial bank interest rates on credit card plans and a 24-month personal loan on the St. Louis Fed's recorded history. But the challenge here is if you were to move your credit card to a 2-year personal loan, the payments are going to skyrocket relative to how long it would take just making the minimum payment on your credit card. But the challenge of what's coming for the banks here is they're going to make it even harder for you to get credit at a time when you really may actually need it. And why getting approved for a credit card is becoming harder and what you can do about it. New data from the Federal Reserve shows that lenders have been getting pickier with whom they approve for new credit cards. About 19% of banks have started tightening their standards for credit card approval over the past 3 months, according to a recent Fed survey. So what I want you to understand is what the banks do here is as the Fed raises rates, they of course raise borrowing costs to you as well. The story they give you is, don't worry, Mr. Customer or Mrs. Customer, you're going to pay more interest now. That's okay, but when rates come down, we're going to lower that rate, so it's okay. Go ahead and borrow. But really, they're fooling you because when rates go down, we already know that not only they're not going to lower rates, they're not going to extend new credit to those customers. They're going to lock them in and force them to pay that high interest cost. As you can see, they do that by tightening lending standards. And here we can note from, again, the St. Louis Fed database, the net percentage of domestic banks tightening standards for credit cards is rising, and this is typically what we see going into a recession. Now, mind you, anything over this black line indicates tightening, so when the blue line is heading lower, that means fewer banks are tightening. When it's rising, that means more banks are tightening. You can note going into the great financial crisis, going into the dot-com bubble, banks tightened standards. You can see as the Fed raised rates, and who is driving this? It's the Fed. Of course, we know as the Fed raised rates in 2016 through 2018, of course, lending standards tightened, and then they really ballooned during the pandemic. And after fiscal transfers came out, well, of course, banks eased to get that money, and now look, they're tightening standards again. And all of this leads to the fact that consumers who need credit are likely going to be unable to get that. And that's one of the big changes that's coming that consumers can't see, but will only find out when it's too late. Now let's dig into that Fed report because it's pretty grim. When questions on consumer lendings to the banks over the third quarter, moderate net shares of banks reported tightening lending standards for credit card loans and other consumer loans, while standards for auto loans remain basically unchanged. Of course, as demand for auto loans appears to be plummeting. Consistent with tightened lending standards for credit card loans, banks also reported tightening most queried terms on credit card loans. Specifically, moderate net share of banks reported wider interest rate spread on these loans and tightening the extent to which loans are granted to some customers that do not meet credit scoring set thresholds. So again, what do you hear in this report so far is tight, meaning fewer people are going to get approved. And that's the challenge here is you have all this debt. Consumers say, hey, I need some relief. And the banks say, oh, well, we'd like to, but you don't qualify anymore. Should have got it while you could. And this is only going to accelerate, as we saw in that last chart. The deeper the recession gets, the tighter banks will make lending standards, making it even harder for consumers to get money at a time they'll desperately need it. Regarding demand for consumer loans, a moderate net share of banks reported, get this, just as I was suggesting, stronger demand for credit card loans. So again, at the time that people want credit card debt and need the money to get through inflation, banks say, no way. And while a significant net share of banks reported weaker demand for auto loans. As lenders navigate increasing delinquencies, a higher inflationary environment, capital constraints, and a potential recession leading to below prime risk tiers is likely to slow down in the last 2 quarters of 2022. So again, this becomes a story of delinquencies, and it starts to make sense as banks sense that you aren't going to make payments or can't make payments. Well, they start to realize that they've lent out too much money, and they start prioritizing getting their money back. The way they do that is by tightening lending standards and say, look, you can't borrow anymore. You need to pay back what you have. And that's how you see this correlation. As delinquencies rise, lending standards tighten. And this is just the beginning of what we're about to see. As rising card delinquencies fuel demand for debt consolidation loans. In supplementals from Credit Card Discover, the credit card 30-day delinquency rate was up to 2.1% in the most recent quarter. Mind you, this remains at historically very low levels, up from 1.8% in the second quarter and 1.5% last year. Digging a bit deeper, we see the delinquency rate on private student loans, topic we covered in yesterday's show, was up 1.9% from 1.6%. And here you can note the delinquency rates again remain historically extremely low, but banks are still starting to panic and tighten lending standards. Again, we note that in periods of high inflation, typically going into recession, the delinquency rates rise. And what that means for a bank is they turn into charge-offs, where banks eventually figure out that someone who's delinquent is never going to pay off the loan. They write it off and take the loss. And that's the big factor here. So what you're going to see coming soon is banks are going to keep tightening lending standards. Consumers are going to want more credit and not going to get it. But due to the Fed raising rates, the cost on their existing debt is only going to go higher. So what can you do about this? Well, you can put a plan to start paying down your debt before you get impacted by higher rates. You can look at options to perhaps balance transfer your credit card debt to a lower interest rate or personal loan. And if all else, if you do need a loan or you're planning to say, hey, Steve, in a couple of months, we're going to probably need to borrow some money. Well, you may want to look to do that now before you go down to the bank and they say you don't qualify. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.